year 2000, Enron was the seventh largest company in the United States. Fortune magazine had named it the most innovative company in America for 6 consecutive years. Its stock was trading at $90 per share. Its executives were celebrated as geniuses who had reinvented the energy industry. 14 months later, the stock was worth 26 cents. 20,000 employees had lost their jobs and their retirement savings simultaneously. $74 billion in shareholder value had vanished. And the entire thing, every dollar of revenue, every award, every analyst recommendation, had been a lie. Not an accidental lie, not an optimistic projection that turned out to be wrong. A deliberate, systematic, carefully engineered deception that fooled regulators, auditors, banks, and investors for nearly a decade. This is the Enron story. And it begins not with greed, though there was plenty of that, but with an idea that seemed genuinely brilliant. Enron was founded in 1985 in Houston, Texas, through the merger of 2 natural gas pipeline companies. For its first few years, it was exactly what it appeared to be: a straightforward energy company that owned pipelines and sold natural gas to utilities and businesses. Then, in the early 1990s, the energy markets began to deregulate. States that had previously controlled energy prices began allowing them to fluctuate based on supply and demand. For a company that owned energy infrastructure and understood energy markets, this was an enormous opportunity. Enron's leadership, particularly CEO Jeff Skilling, who joined the company in 1990, saw something that most energy companies missed. If energy prices could fluctuate like stock prices, then energy itself could be traded like a financial instrument. You could buy and sell contracts for future energy delivery. You could create derivatives based on energy prices. You could, in theory, turn a pipeline company into something that looked more like an investment bank than a utility. This was the idea that made Enron famous, and for a time, it worked. Enron created energy trading markets that genuinely did not exist before. They invented financial instruments for buying and selling natural gas, electricity, and eventually broadband capacity, weather derivatives, and dozens of other commodities. They employed hundreds of traders and analysts, paid Wall Street salaries, and built a trading floor in Houston that looked more like a hedge fund than an energy company. The revenue numbers were extraordinary. Enron's reported revenue grew from $13 billion in 1996 to $100 billion in 2000. In 4 years, the company appeared to have grown by nearly 8 times. The word appeared is doing a lot of business model was not that energy trading was fraudulent. Energy trading was real and generated real revenue. The problem was that the real revenue was never enough to justify the stock price, and rather than accept that, Enron's leadership chose to manufacture the numbers that the stock price required. The mechanism was accounting, specifically a type of accounting called mark-to-market, which Enron had received special permission from the Securities and Exchange Commission to use in 1992. Mark-to-market accounting works like this. Instead of recording revenue when cash is actually received, a company records the estimated future value of a contract the moment it is signed. If Enron signed a 20-year energy supply contract today, they could book the entire estimated value of that contract as revenue today, even if the cash would not arrive for 2 decades. In a legitimate business with accurate projections, this is defensible. In Enron's hands, it became a machine for inventing revenue. Skilling and his team would sign contracts, estimate their future value at optimistic, sometimes wildly optimistic figures, book that value as immediate revenue, and report numbers that made Wall Street analysts celebrate and the stock price rise. When the actual cash flows failed to materialize, the gap was hidden through a second mechanism: special purpose entities. Andrew Fastow, Enron's chief financial officer, constructed a network of hundreds of shell companies, entities with names like LJM Cayman and Raptor, that existed for a single purpose: to absorb Enron's losses and keep them off Enron's balance sheet. When Enron had a failing investment, it would sell that investment to one of Fastow's entities at an inflated price. The entity would take the loss. Enron's books would show a gain. The entity was capitalized, in part, with Enron's own stock, meaning the whole structure depended on the stock price remaining high to stay solvent. It was a house of cards, in which every card was another card. The auditors who were supposed to catch this were Arthur Andersen, at the time one of the 5 largest accounting firms in the world. Arthur Andersen had a conflict of interest that made genuine scrutiny nearly impossible. They were earning over $50 million per year in fees from Enron, split roughly equally between audit work and consulting. They were, in practical terms, financially dependent on the client they were supposed to objectively verify. The analysts who covered Enron on Wall Street were almost universally bullish. Of the 17 analysts covering the stock in 2001, 15 rated it a strong buy or buy. The banks that employed those analysts had lucrative investment banking relationships with Enron that created the same conflict of interest as Andersen's consulting fees. Every institution that should have caught the fraud had a financial reason not to look too hard. The person who looked was a woman named Bethany McLean, a reporter at Fortune magazine, who, in March 2001, published an article with a simple question in the title: "Is Enron overpriced?" McLean had asked Enron's investor relations team to explain, in plain language, how the company actually made money. They could not give her a clear answer. The article noted this, pointed to the complexity of Enron's financial statements, and asked whether the stock price was justified. Enron's response was aggressive. Skilling called McLean on the phone and accused her of being unethical. Enron's PR team contacted Fortune's editors to complain. Fastow flew to New York to meet with McLean and her editors in person to defend the company. The article published anyway. It did not immediately crater the stock, but it planted a question that refused. The questions multiplied. Short sellers, investors who profit when a stock falls, began accumulating positions against Enron. They had done the same analysis McLean had done and reached the same conclusion. The financial statements did not make sense. In August 2001, Jeff Skilling abruptly resigned as CEO after only 6 months in the role, citing personal reasons. He sold millions of dollars in Enron stock before resigning. The stock began to slide. In October 2001, Enron reported a $1 billion charge related to Fastow's special purpose entities, the first public acknowledgement that the off-balance sheet structures existed and had created losses. The SEC opened an investigation. In November 2001, Enron restated 5 years of financial results, acknowledging that it had overstated earnings by nearly $600 million. The restatement confirmed what the short sellers and McLean had suspected. The numbers had been fabricated. The stock, which had been $90 per share in August 2000, fell below $1. Enron filed for bankruptcy on December 2, 2001. At the time, it was the largest corporate bankruptcy in American history. 20,000 employees lost their jobs. Most of them had been encouraged to invest their retirement savings in Enron's stock that was now worthless. They lost their jobs and their retirements simultaneously. The legal consequences were significant. Fastow pleaded guilty to fraud and conspiracy and was sentenced to 6 years in federal prison. Skilling was convicted on 19 counts of fraud, conspiracy, and insider trading and was sentenced to 24 years, later reduced to 14. Kenneth Lay, Enron's founder and chairman, was convicted on 10 counts but died of a heart attack before sentencing. Arthur Andersen, the auditing firm, was convicted of obstruction of justice for shredding Enron-related documents after the investigation began. The conviction effectively destroyed the firm. It surrendered its accounting licenses and ceased to exist as a major firm within months. 85,000 people who worked at Arthur Andersen globally lost their jobs because of decisions made by a handful of partners in Houston. The Enron scandal directly produced the Sarbanes-Oxley Act of 2002, the most significant reform of corporate accounting standards since the 1930s. CEOs were now personally required to certify the accuracy of their financial statements. Audit firms were prohibited from providing consulting services to clients they audited. The penalties for corporate fraud were dramatically increased. So what is the actual lesson of Enron? The easy answer is greed. Skilling and Fastow were greedy. They built a fraud to enrich themselves, and they were punished. The real lesson is about systems. Every institution that was supposed to prevent what Enron did, the auditors, the analysts, the regulators, the board of directors, had a structural reason to look the other way. Not because they were all corrupt, but because the system had been designed, over time, in ways that made honest scrutiny financially costly. Arthur Andersen was not corrupt in a simple sense. They were a firm whose business model had evolved to the point where losing a client like Enron was genuinely catastrophic, and where that financial pressure made aggressive questioning of the client's numbers professionally dangerous. The analysts were not corrupt in a simple sense. They worked for banks that needed Enron's investment banking fees, and in that environment, a sell rating on Enron was a career risk that most of them chose not to take. Enron did not succeed as a fraud because the people around it were uniquely dishonest. It succeeded because it understood the incentives of every institution it needed to deceive, and it structured its relationships to make deception the path of least resistance. That is the most dangerous kind of fraud. Not the kind that requires everyone to be corrupt, the kind that only requires everyone to act in their own financial interest. The lights in Enron's Houston trading floor went dark in December 2001. The stock certificates were worthless. The special purpose entities were unwound. The pipelines were sold. What remained was a federal law, a destroyed accounting firm, 20,000 ruined careers, and a case study that is taught in every business school in the world. The most innovative company in America, 6 years running. It just wasn't innovating in energy.